Well, when we launched the funds at outset just over a year ago, that was in January 2015, we'd had a period of uncertainty just before we launched in the fourth quarter of 2014, and we felt that might continue. And we were perhaps a little cautious in getting too much risk asset into the portfolio because our outlook was a little bit defensive and a bit too cautious. And markets had a good run in the first quarter, and we did get a little bit left behind. Our focus of risk assets has probably been throughout biased towards east versus west. So we've been pretty defensive because we've been for some while feeling that central banks would lose control of asset prices or supporting asset prices, and that there are too many problems out there from a macro point of view. Interest rates lower for longer because monetary policy from central banks around the world and what they've been doing is not, is not changing that. They've thrown a lot of money at something, and the world, and it's not changing that. And global growth is on the decline still. We get all these government hopes that GDP numbers are going to pick up, but virtually every revised number is downwards, and that's unfortunately the way it's going. So slow growth, low interest rates, disinflation, deflation even maybe, and probably I wouldn't be surprised. It wouldn't take a lot to see one or two areas of the global economy move into recession. So that's a bit gloomier than a lot of other people are suggesting. So we don't think we're out the woods on that one yet. So we positioned ourselves reasonably defensively. We did too early move into some protection with gold around middle of last year, which didn't initially do us much good, but has helped us immensely with the more volatile times recently. We've positioned ourselves within the funds certainly on balanced and opportunities at the riskier end to hold quite a reasonable chunk of assets in non-sterling. So we've had up to half in mainly dollars and some yen assets there, which has done us particularly well as sterling has weakened. Volatility creates opportunity, it creates crises and panics and things like that. Things sell off that probably shouldn't, or you do get babies in bathwaters situations, particularly with ETFs. ETFs change the world quite a lot in terms of how people react. So they sell a market. Well, a market's got good stocks and bad stocks in it. They sell an index. They sell a pile of something or other. So, and it gives the active fund managers who have had a difficult time over the last few years more opportunity to actually exercise their views of life, because we're principally fund to fund. Open and closed end sector, so the good fund managers, it gives them more opportunity as well. So it works well through. So opportunity. It brings a smile on our face when we see things getting oversold. If anybody thinks that Europe's suddenly going to ban our exports into the UK's exports into Europe, has got another thing coming. Europe exports far more to the UK than we export to them. They're going to keep those flows going. Nothing's going to change that that I can see of, or not materially anyway. So I don't think it makes much difference there. It doesn't seem that anybody's really taking control of the destiny of the European Union. The euro has always been a huge mistake. You can't have a currency union that's going to work properly without fiscal and political union with it, and it's the wrong way round. Should have come third. Is there a chance of that really happening? I don't know. There were some people who would say, and have said, that the UK is better to get out of Europe before it implodes anyway. That's probably a little bit aggressive. I'm not sure that it implodes, because it will probably exist in some form, but it doesn't seem to be developing or going anywhere at the moment. In fact, almost going backwards. They can't seem to agree on anything. The shambles over borders and Schengen and all that's been going on with the Syrian crisis and refugees. Long story, and it's a long time ago. But I got into the fund management side of things way back in, I suppose, early 1980s, but more on an advisory basis perhaps then. I went through a period in sort of mid-1980s where we set up discretionary portfolio funds. But it was when I took over existing funds, fund management, around 1986, that I realised that that's what I enjoyed the most, fund management, which is a very different style of running money to discretionary or advisory, because you're there making decisions on a day-to-day basis or a month-to-month basis, and you're measured on a day-to-day basis. Retail funds are valued on a daily basis, so it's a different mindset, and I've always enjoyed that. So that's developed over the years. My style, and 86 was a good time to start because we had 87, and got me going in difficult circumstances. So yes, I started out with IBM, but then went to a business that became Roxburgh, and which was an IFA business in the City of London. But then I got involved in one or two other things at the same time. A business called PBR Fund Management, and another business as well. The Roxburgh businesses were bought by BFS Group briefly, but I bought the funds out of that to join Miton in, that must have been 1997. My business partner there sadly died 6 months later, and I took over the business of Miton in 1997, late 1997, and we progressed the business from there in Reading, which is where it just got shifted to, and right the way through to 2014, and there were lots of changes through that Miton business. When I took the business over, it was running 15 million or something like that, and when I left, the Reading side was running around $1 billion. So we progressed the business quite well. So, totally focused on the multi-asset side of things. In other words, what we were doing at Miton in Reading. So totally focused on that. We'd like to launch more funds. We've got 3 at the moment, as I say, defensive, balance and opportunities. We would like to launch an income fund, and we've got other ideas as well. Well, I think there are opportunities in 1 or 2 individual sectors, like potentially running a low volatility, more defensive style of real estate or resources potentially, but that's some way down the line. Would like to launch an investment trust as well. That's been on a radar for a long time, and has nearly got off the ground a couple of times in the past. But we'd certainly like to do that on a closed-end fund on a macro basis. But these are things that are for 2017 and beyond, not for today. But there are ideas there. But we want to develop the business, grow the business in this space for what we're known as doing. The ethos is private company, run by the people within the company. We will specialise in doing what we're good at, which is running money, distributing that money, and the operational support of that business. We will outsource most of the other functions to people who are professional in those areas, doing it our way without having to worry about other people's thoughts or conflicts, which had perhaps sprung up a little bit at Miton because the main focus was moving towards single strategy. Nothing wrong with that, but it did conflict a bit in terms of how we will, our vision for the future. We want to enjoy success, work together closely, work together in difficult times. And to be honest, 2015 was more difficult than we envisaged in the environment of the marketplace, and also the regulatory issues that have changed in recent years. Our marketplace is the advisor and wealth manager marketplace, totally 100%. We do not work with the institutions. We're totally in that marketplace. And that's a very difficult marketplace because they've been forced to go down rating agency routes rather than selecting their own funds on their own knowledge. They've been forced to use more platforms. You've got to get on all the platforms, which is quite hard work. We've successfully achieved that. The rating agencies have been harder. Our argument is, well, look, you've got 20-year track record of management style with a 6-month gap. Surely that's good enough to rate the fund, but they're dead scared, and they're still looking for longer term performance than a few months or 6 months when we set up Coram. Now we've got a year under our belt. That should help, but it's still an uphill battle to get the funds rated, despite everything. So those are tough issues. Getting funds launched, we did that very, very quickly, which is down to expertise that we brought with us, because the core of everybody here is ex-Miton, which is good. And yes, it's been hard. So we're behind what we expected for last year, but the good news is this volatility in markets has seen a sudden real uptick in interest and flows over the last few months. So that's been nice and refreshing when we were getting a little bit nervous about what people perhaps were thinking of a new set-up business. So that's been very good. So along with the market volatility, etc., it's been a happy place this year. The style is no real difference to where we were before. We're looking for real returns over a period of time rather than relative returns. We're not interested in benchmarks. We're benchmark agnostic. We will sit in sectors, and we're about to, now we've just had a 1-year anniversary, have the funds into what I still describe as cautious, balanced and active sectors. They're called something else now, but we're not interested in trying to relative performance. They'll just sit there because they need to be somewhere. I think the most noticed successes have tend to be in poor markets. So over the years, this goes back even pre-Miton, 1990, 1994, but certainly through 2001-2. At that stage, you just had strategic, and in 2002, strategic made a small gain, and that was very, very hard to achieve that in those markets, and I think only 2 or 3 funds managed that in that period of time. Perhaps more recently, got particularly noticed at Miton because in 2008, both strategic and special situations both had positive returns during that year, and again there were very few funds. I think there was about half a dozen in total that actually had positive returns in the managed sectors. So, but there have been other good periods as well, and along the way plenty of disappointing periods where we've just been out of kilter and away from what's been going on. I'm sort of a data reader-aholic, if you like. There's nothing better. I look forward to my Saturday mornings, sat at my desk at home, with the week's FTs, what I haven't read of them, which is often quite a lot of it, any other research material that I've stacked up, and sometimes I'm catching up with research material and things that I wanted to read that are 3 or 4 months out of date, but it doesn't matter because the detail's still there, the interest is still there. These things don't change overnight. That's not our style. So there's a lot of reading done, not just by me, but and we discuss a lot of those things. So we've always formed our own views. I am not interested in a Fidelity or a Goldman Sachs' views on the market. It's tempered to what they're doing. We try to get as much independent research as we can. That's difficult because everybody puts their own taint on things. But as much raw data, raw research that we can get, what's going on around the world, what's happening in China, India, Brazil, as well as what's happening in Germany, UK, France, so it's in America. So we like to dig down deep. We're not looking because we're looking for opportunities and value that other people are overlooking. So we're looking in other areas, and it's not just equity markets. It's bond markets. It's property markets. It's it's other kind of debt markets. It's the whole gamut. It's everything. Where the opportunities lie. Where's something turning? What's going on? It can be all sorts of things. The East versus West theme, particularly in Southeast Asia, which has been an awful place to invest over the last 5 years. But ASEAN, which is those 10 economies in Southeast Asia around Singapore, there's whatever it is, over 600 million people in that area with an average age of 20-something or other. It's exciting. It's potentially great. Politics are not too bad, but they've struggled. The market's got overvalued, and they're probably a bit cheaper now and looking a bit more interesting. What's going to change that? When do you invest? How do you do those things? And we're probably looking at things earlier than other people. My style has always been buy early, sell early. Don't try pick bottoms and tops. You're crazy if you do, because you'll get set targets as to where you think you're going to get really interested in something. Be patient, and then be patient, and then be patient. Bide your time. Don't have to make a decision on the spur of a moment. Best decisions are always slept on, generally. Occasionally it's worth making a quick snap decision, but very rarely. What do I do with spare time?
That you'd wish to share with our readers and viewers?
I'm probably well known for enjoying live sport. Great follower of rugby, cricket. Less so these days. I've always enjoyed horse racing, but that was something from my school days and early working career. I like horse racing from a fun point of view and going to watch racing, but not as a betting proposition.
You still loving it?
Absolutely, I live and breathe the market, so it's fantastic. It's not obsessed by it, but on the other hand, I just love what's going on there. So it's leisure to me, as I said. Sitting and reading an FT with a pot of tea and then another one over weekends is particularly in the summer when you can sit outside. I've got a lovely garden, lovely views over Lyme Bay. So how lucky am I?